The buy side is here initially because we have this high and we have the slightly higher high. Now, I could very easily just say, well, let me just anchor to that. But because we're in a really prolonged trading range, it could just very well trade above this high and then just bump that high and never get above that high. So when we're playing inside of a large trading range like this, I like to be a little bit more nimble and not require it to do the extremes. So you can make a whole lot of wonderful setups using 75 to 80% of the trading range high and low and never trade outside the range and use these smaller short-term highs and lows inside that larger range, meaning that if this was the high of the range and this being the low of the range down here, if we put a fib on that and put in 80 and 20 as the levels, if every swing high that was at or just above, but not the actual high here of the trading range that's being shown here, if you look at the extremes of 75 to 80% or the lower extreme and not piercing the 20%, I believe that you would be able to focus on the ideal little intraday turtle soup formations. They could act as targets or they can act as new entries. But because we're looking at analysis and we're looking for forward thinking setups, the sell side that I like is here, right there. Notice that it's below the low here and this low here. Now, why am I making the jump to this low here? Why didn't I use the same logic here? Well, it's because this low actually went just below that one here. So this is already lower than that one. So that means that it would technically be this low and this low being the relative equal low. So I'm going to take your attention to the lower one because in a perfect world, all things being equal, that's where the sell side is going to be. I could be wrong. I'm completely content with being wrong. And sometimes you've seen me get my targets hit by price delivery, but the limit order simply not get filled. And that's unfortunately the price you pay when you're trying to be so surgical and precise. So those are my liquidity pools on the hourly chart. I'm going to drop down into a 15-minute time frame. And here is that balanced price range. And I have it very lightly shaded. But if you're a member of my Telegram, it is very, I guess, satisfying to see what we were looking for this week trade down just below that low by a tick. Look at that. That little tiny little stab below that. And then we had all this price movement moving higher. We're going to break down Friday's price action, but I want you to take a look at this 15-minute time frame. Pause the video and think about why price went to this level here before closing. All the way from this low, all the way up here. Why did it draw here? So I want to take your attention to that candlestick right there. That's 10 a.m. on Thursday, okay? I'm not going to add it to the annotations, but I want you to write that down in your notes, and you should be writing things down as I'm talking to you in these lectures. But that 10 o'clock candlestick right there, I want you to annotate that, okay? Because we're going to refer to that at the last few minutes of the review, if you will. All right, and it's the 5-minute chart. And again, I want you to think about what you see here in this chart. But again, in that same proximity, right in here, I want you to look at that on your chart as well. I'm going to annotate that. Now we're going to break things down. This level is the low of that balanced price range that I gave you in the Telegram channel. Before it traded down through it with high resistance liquidity conditions, it went right down to it and through it by a tick. And that was the low. That was the low of Friday. And then all the way back up to here. Wouldn't it be interesting? Wouldn't it be enigmatic if you could determine where that high was going to be? Finally, we made our way to the 1-minute chart. All right, so we're looking at the New York kill zone. New York kill zone is the same for forex, okay? It's basically the 7 a.m. Eastern time to 9 a.m. Now, you can extend that 1 hour before and 1 hour after and just completely answer all the problems of daylight savings time. But if you're going to be a purist, meaning that you're going to stick to the rules as I first presented them, it's 7 a.m. Eastern time to 9 a.m. Eastern time. That's essentially, in futures trading, it's pre-market trading. So you're trading ahead of the opening bell at 9:30 Eastern time. So if we look at the NASDAQ on Friday, let's break that down in here. So we have 7 o'clock, starts this period here, all the way through till 9 a.m. Eastern time. We have relative equal highs in here. The market rallies up, takes that buy side liquidity. I'm going to challenge you to go further to the left on your chart, on your 1-minute chart, and you'll see there's a fair value gap that it trades up into there. But sticking just to the liquidity aspect, the buy side's taken here, and then we break below that short-term low, which is what? A shift in market structure is bearish. Then the market trades higher. This is model 2022 in and of itself. For the folks that guys, oh, I ain't seen it working in months. I don't know what you're looking at, but it's working every day. The market breaks down, and this is an institutional order flow entry drill. And that simply means that this candlestick didn't get completely filled in or closed in and repriced back to the previous candle's low. This candlestick's buy side imbalance, sell side inefficiency. Then this SIBI, sell side imbalance, buy side inefficiency, creates a balanced price range there. That's why you would expect to see an institutional order flow entry drill. The easiest way to anticipate the institutional order flow entry drill is if there's a balanced price range in the fair value gap that it's trading up into. 9 times out of 10, if you're bearish, it's not going to completely close that in. And that means you can do a very shallow run above that high as your entry and not try to use the consequent encroachment or the entire range closing in on the fair value gap. Toss that in there, no extra charge. And then we break down with displacement again. And all of these candles here, the lowest opening price, that's changing the state of delivery, trades up into the bearish order block, and then it breaks down there. Once we get below this low here, we do so on a expansion. It's heavy displacement, meaning we have a candlestick that creates what? A fair value gap. Since it's done that, below this low, and here's the main thing, we talked about this in Telegram before it reached it. I told you in Telegram, I'm interested in getting below that balanced price range of the 18th and the 19th of March. So the draw on liquidity is what? Is it bullish? No, it's not. We're up here. So this displacement here, once it gets below this low here and does that, we want to see it stay open. And if it stays open, it's going to act as what? A breakaway gap. Then the market breaks faster, and then we have a big sell side imbalance, buy side inefficiency, right where it should form. What do I mean by that? Well, if you take this gap here, it's roughly, by eyeballing it only, it's about halfway from the high to where it's formed to where that line is here, that red line at 19,604.25. That's the low of that balanced price range. I wanted to see it go down below that and explore below it. It did. It went down a tick or two below it and said, that's enough for me, and went back up. But that's still what we were looking for. So if this was the draw on liquidity, and best case scenario would be trading down to that sell side, I made no mention of this as a hard selling point. This level here absolutely was called in advance in Telegram. Once the market reaches down here, we can very easily see that that was a measuring gap. But I'm sure you probably want to see some more details to prove that was a measuring gap, right? As the market breaks down, since you know this level down here is that low of the balanced price range of the big trading range of the March 18th and 19th price action, if you drop a fib from this high, and we'll do it here. You anchor your fib to the high and you pull it down, okay? So since this is a static chart and it's not me doing it live over a chart, imagine my cursor's just like that. I'm holding it right there. I want you to take your attention to that red level right there. That's the 50% level on the Fibonacci. As I pull the fib down, I'm trying to eyeball this 50% level and line it up with the middle of the measuring gap. So I'm going to overlay this red line with this dotted line, which is half or the middle of this sell side imbalance, buy side inefficiency. So I'm going to pull it down from here, and I'm going to aim for that level right there and drop it. And it looks like this. So I pulled the fib from this high all the way down. There's where my cursor would be until the 50% of the fib anchored to that high stops me here because the 50% level laying over top of the consequent encroachment of this gap, that gives me the perfect measurement for measuring gaps. Okay, or it's basically like the equilibrium or grading a price swing. We can anticipate where measuring gaps are going to form if we know where the draw on liquidity is. Isn't that fascinating? Isn't that fun? How about where does the breakaway gap form? Around 20 to 30% of the implied dealing range. What's an implied dealing range? Implied dealing range is when the market was up here and you anticipate selling off. Where's it going to sell off to? Well, we wanted to see it go down below that 18th and 19th balanced price range of March. That's this red line down here. So we can take a fib and just loosely take it from the sell-off point and drop it right on the red line here, and you're going to get a general proximity where that midpoint is. But it's further refined when you actually use what? Price run in and of itself as it forms, candlestick by candlestick. So here is the upper quadrant of that implied dealing range. An implied dealing range is a price run that has not completed yet. If you're bullish or bearish, where your terminus or target is, which is this level here that was qualified and quantified inside of the Telegram channel before it reached it. So by having projections like this, we can grade our price swings. And breakaway gaps are wonderful to anticipate near the 20 to 30% of the price range that has yet to deliver, and then 50% of it. See that? So if we know that this is the midpoint, which qualifies and confirms this is a measuring gap, this level right here stops when we get this overlapping of the midpoint and 50% of the fib. This level here, pay attention now. Look at the bodies. See that? Isn't that beautiful? But the wicks are allowed to do the damage. What did they do? They went down just below that low I told you, and it went down below it by a tick, and then it came right back up to close inside of the level that is projected for a perfect measured run. So the implied dealing range came to perfect fruition, and it's confirmed with what? Look at the bodies. Stopping right where the fib qualifies, that being the measuring gap. So the bodies confirm that has been delivered perfectly, and the wick has told you what? The damage is done. We traded below that 18th and the 19th price action. We've done it here, and then we had this run above this short-term high right there. What is that? That's a shift in market structure. So we can anticipate the market doing what? Going higher if it breaks out and starts running. We see it deep dive, doesn't take out the low, but the bodies are doing what? Staying in that level of that implied dealing range. Then it starts to rally. There's details in here that we're going to ferret out, but you can anticipate price doing what? Breaking this high. Now, why? 9:30, we have the opening range. The opening range is 9:30 to 10 o'clock Eastern time. The opening range of 30 minutes. What do we do with that information? Well, obviously you have to know the low of it and the high of it, and that's what I've annotated here. So by having that range defined, we start looking for first presented fair value gaps. Now, if you're an order block trader, you're going to wait for the first order block to form that's salient to your bullish or bearish stance on the session. It may be breakers. It may be a institutional order flow entry drill. It may be a propulsion block. It might be a volume imbalance. It might be anything that I've ever taught. That's your TD array. But I'm pushing the first presented fair value gap because it's good. It's like a silver bullet. It's like it's there. It's always going to be there. But there are some aspects to first presented fair value gap that I want to include here today. If you have a very small, and there's going to be times where you look at the individual price action of any given day and you may question, is the first fair value gap really valid or should you use another one? And the general rules are this. Obviously, when we're looking at inside this range, from this candle's high to that candle's low, that's the actual range. But the range in time is here from 9:30 a.m. Eastern time to 10 o'clock Eastern time. So you're having to look inside that portion of time for the very first presented fair value gap or the very first PD array that you're going to employ as your model. The easiest one to spot is the fair value gap. All you have to do is narrow your focus down to the first 30 minutes because the algorithm is going to leave something there for smart money. It's coded to do that. If the gap, as you'll see here, that's the very first one. See it? There's no other fair value gap on the 1 minute time frame forming prior to that right there. Now, would you agree that that's a very small fair value gap? It's minuscule. And it really didn't do anything, did it? Did it take price down to take a lower low out? No. So there's one strike against it. We already made the low of the day at a level we anticipated. So if we went down here, isn't it likely the market's going to go higher anyway if it rejects like it's done here? We have a shift in market structure. And then we're inside of the opening range of 9:30 Eastern time. So we're only coming back down to test that low. And it didn't even get down to the low of that 18th and the 19th balanced price range. So as I teach, the signatures are, we want to see levels fail. We want to see PD arrays fail. That's insight. Small little gap like that. That's the first presented fair value gap of Friday. It's a fair value gap that's a SIBI. So that means generally that would be treated as what? It trades back up into it and sell off. But that's canceled out because we reached our target. Now we have a shift in market structure here, and we didn't take out the low there. So we're inside of the 9:30 to 10 o'clock opening range. So if we take out that high, we really have what? We have a move outside of the opening range higher when it should be bullish because we've hit our target for the week and we rejected it here. So wouldn't it be favorable to see a larger fair value gap than this one that's in an opposing direction? If this is a SIBI fair value gap, in other words, it's a down close candle, this is what you'd see the opposite of, which is a BISI, buy side imbalance, sell side inefficiency. And notice the difference in contrast of its displacement. Significantly larger, isn't it? This would be your very first presented fair value gap within the context and narrative of what you have in price action here. Then the market trades above the opening range high. There's your breakout. We don't trade breakouts, but that's a break above it. We don't need it to close above it. The market trades down into that again, right there. What time is that occurring? At 10 o'clock. That's your silver bullet. It forms every day, folks. There's never been a day where silver bullet never formed. The market rallies again and trades into that old measuring gap. Now, because we went above it here and we've got the narrative behind us that it's likely to trade higher now, this inefficiency that was a sell side imbalance buy side inefficiency or measuring gap, now we can treat it as an inversion fair value gap. Look at that. Look where it's forming. If you have a market that's changed gears and direction, now it's bullish. If you can get above the opening range high, and if there's liquidity that's obvious in the charts, here, this gap over here, when it was going up to run the liquidity out, that's a buy side imbalance, sell side inefficiency. But when the market changed gears, that turns this into what? A premium array in the form of an inversion fair value gap. The market goes down into the opening range high and the low of this inversion fair value gap that was the measuring gap. So it's forming basically a pseudo market maker buy model. Okay, that's what it's basically forming. Bodies real close to inside that inversion fair value gap, but it hits the opening range high and then creates another fair value gap there, trades outside of that inversion fair value gap, comes right back down again. Here you go. This is another silver bullet inside the hour of 10 o'clock, displaces to the upside, runs the buy side here, and trades right up into the inversion fair value gap. And we don't even need that buy side taken there for that. Those are two trades right there that are beautiful. Moving forward in time, here's that inversion fair value gap that was projected over here, and that buy that was running off of that. Then the market retraces and trades down. And what is it doing? It's trading back inside of the opening range. I'm not saying opening range gap. It's the opening range. It's the first 30 minutes, 9:30 to 10 o'clock Eastern time. Now, I have added the Fibonacci to the opening range, low to high. That's what I did here. And I added the upper quadrant and the lower quadrant. Now, if I'm bullish on a market and it trades down inside the opening range, I'm going to be watching that upper quadrant. Oh my, you feel that tugging in the corner of your mouth? Go ahead, let it happen. Smile. Trading down into that upper quadrant of the opening range. The first 30 minutes of trading, 9:30 to 10 o'clock. That's algorithmic. It's also occurring at a very specific time. This is where the lunch macro begins. 11:30, right here. That starts that whole overlapping of what already has happened. What's happened already? The market traded lower from here. There's buy side resting above that. So at 11:30, whatever you've been doing, anticipate some measure of retracement and grow in the other direction. Not all the time, but the majority of the time you're going to see that. Now in this case, because we had the target reach for the week, it's probably going to go higher. And this is the lunch macro. The lunch macro is 11:30 time, Eastern time, as far as 1:30 p.m. Eastern time. So it's a 2-hour window of time that's collectively referred to by me as the New York lunch. Okay, so by hitting the upper quadrant of the opening range, when it's bullish, you can time an entry in here to go higher. Now you can use an inversion fair value gap here. You can use a turtle soup, or you can anticipate the run back above here and trust that it will give you a fair value gap, some kind of order block. In this case, you can see very, very beautiful immediate rebalance there, and then starts to run higher. These levels are standard deviations. The standard deviation of the opening range, the first 30 minutes, 9:30, 10 o'clock. This is a half a standard deviation, 1 standard deviation, 1.5 standard deviation. And it trades up to that after taking the buy side out here, right here, Beautiful delivery, algorithmic, all perfectly delivered. Now at that point, we're going to take our attention and scrub forward again. This gap here, we're going to extend it forward, but now because price is above it, I'm not going to change the color because I don't want you to lose sight of what it is I'm referring to in proximity to that. So just know that once we went above it here, this would be referred back to as a reclaimed bullish fair value gap, not a bearish fair value gap. But I want to leave it this way so that way you can follow it in the slides of my PowerPoint presentation here. That's it here, extended all the way over. So here's that run up to that standard deviation 1.5. And then one more time it bumps above it and trades down into the lunch macro ending at 1:30 p.m. And now we're creating what? The opening range, the first 30 minutes of 1:30 to 2 o'clock Eastern time. That's what sets the tone for the market structure. All of the magnificent and precision-oriented aspects that I teach, it all starts from here. So we have the opening range low. This is the lowest low between 1:30 p.m. Eastern time to 2 o'clock Eastern time. That's the highest high it formed. This is the time aspect. Okay, this is the parameters on time. This is the opening range low, the lowest inside that range of time. So if we were following it down here, 2 o'clock to 1:30, that's what this is showing here. It's the end of the lunch macro. So now we're anticipating another run in price action. And since we've already anticipated a reversal because we hit our weekly target, so we can anticipate what? A continuation to the upside. See how that's we work together to build a narrative based on what has happened and what's less likely to happen. The less likely for it to continue lower because we've already traded below the weekly target of the 18th and 19th bound price range, and it rejected strongly on a Friday. So now we have the opening range high, and then inside that opening range, here's your first presented fair value gap. Oh my goodness. This looks like someone's put this together. Like there's a real storyline behind all this. Uh-huh. But the market trades down into that first presented fair value gap here and rallies up. That right there is a tradable run. But now we're going into a macro, 250 to 310. And the market's doing what? It retraces all the way back down to -1 standard deviation of the opening range of 9:30 to 10 o'clock. That's what these lines are here. Okay. So again, we go down to that inversion fair value gap, which is technically a bullish reclaimed fair value gap. Between 315 and 345, the market's going to operate inside of the narrative that's presently underway. Meaning what? We've created another opportunity to buy. We have buy side up here, which is also the opening range high of 1:30 to 2 p.m. Eastern time. If you look at the high here, that's a macro. That's a macro. That's 1250 to 110 macro. And what does it do? It retraces back down into that gap. And it's also trading down into -1 standard deviation of the opening range at 9:30 to 10 o'clock. But during the 315 to 345 macro, it's 30 minutes. You're looking for the setup that leads to market on close macro. That's what MOC stands for. That's the 350 little price run that usually takes off and creates another higher high or retracement into the range. Here, we know that we have 2.5 standard deviation that would take us above this high. This one's very close, but if you look at this price run here, it duplicates itself there. So we're seeing another measured move, but it begins at the time and on the price inside of the opening range in the afternoon session. That's this one here. Look what it's doing here. Body stopping at the consequent encroachment. The wicks go down just below, but doesn't completely close it in during the 315 to 345 macro. Bodies are staying in the upper half. What is it telling you? The algorithm is signaling to smart money, just like it's been coded to do. Stay out of that area. That gives them confidence that that's the setup to buy and run it into the close. And look for rocket fuel at 350. And here you go. That candlestick's 350. And wouldn't you know it, look what happens. Right up to -2.5 standard deviation. So there's obviously no algorithm, right? No way. Nope. Not here, folks. Nothing to see.